Hello and welcome all to the course Investment Decisions. This is online lecture number 1 about financial entities and accounting. So I will first introduce where the course is about. Inside the domain of economics, all the way at the top, there's basically two parts of economics that you can focus on. You could focus on macroeconomics, which is the larger systems, talking about currencies, global resources, global markets, and banking. And there's the side of microeconomics, the smaller environment where it can be mainly about different economic entities, such as the economics of a company, a government, or an institution. In this course, we will mainly focus on microeconomics, and we will also take into account a little bit about capital. So how can I invest? And that money mainly comes from banking. Inside microeconomics, we usually talk about different economic entities. And in this case, an entity has the meaning of a closed address or a closed place where money can flow in and flow out. So there's, for example, private situations of people, and you can call them an economic entity because they usually spend money and they earn money. And sometimes they collect it, they invest it, they save it, or they sometimes even add value to something. Then there's an economic entity called small businesses. We have corporate businesses, governments, and also other institutions like non-governments. It must be said that this overview is a very limited, very simplified picture, schematic of the most important entities that we will discuss during this course, and a couple of factors which will help us determine whether we're dealing with one entity or another. Well, one of those factors is how does the business model look of this entity. Basically, there can be two types of business model. A business model that's actually focused on making profit, and business model that is actually based on non-profit situations. So some entities like privates, small businesses and corporate businesses, they are usually intended to make profit to a certain extent, whilst government and non-governments are actually non-focused on profit. They are focused on continuity. Also, in the way that they deal with tax, there's a big problem, a big difference. Usually, private people, they have one moment where they pay a certain amount of taxes. Depending in which country they live, they can pay taxes to different levels of government, but in the end, they just pay taxes once. That also counts for small businesses, for bigger businesses, and for corporate businesses, for instance. They have a lot of ways in which they pay taxes. That's going to be important for later in this course. So usually the type of taxes they pay is more complicated, and the percentages, for example, depend not only on how much profit they make, but also on which and how much resources they use. Governments, they have multiple ways to receive taxes. They receive taxes from companies, from small businesses, from people like you and me. And non-governmental, they sometimes even receive taxes via a detour, and they also pay a certain amount of taxes depending on what their purposes. Then ownership of this entity. So private is actually not owned because it is simply part of somebody's life. So we call it private. And small businesses are also usually private. They're privately owned. So the small businesses usually started up by a certain person or group of persons, and they own the company. That makes it private owned. Corporate businesses are usually publicly owned. That means that anyone could be the owner of the corporate business, depending on whether you want to buy shares or not. Governments are obviously not owned, and that also counts for institutions like non-governmental organizations. Finally, we have the purpose of the entities, which can be continuity, or it is focused on products and services. And here you see that usually the most entities are focused on products and services, whilst also some people can be focusing on continuity. They don't produce any certain service or product, but they need to also be able to spend money, for example, tomorrow or the week after. To what type of entity do the following examples belong? So now you can pause this video and you can use the examples below to kind of categorize them in these 5 entities. What I must also conclude is that this is a very simplified version. So there's a couple of exceptions to these, this table that I produced. How do you know when to invest? Well, in order to do that, we need to make a picture of the financials of this entity. And this picture is actually made by accounting. Accounting is an economical financial term of actually checking what is there and what is not there, in Dutch boekhouden. So what we need to know is, how is the entity financed? What part of the values of a company is truly part of the entity? What's the entity worth? And if we know that, we can basically calculate how much money is left, which can be done for investments. In order to assess this, we will make a financial picture of this entity and we put it on a so-called balance sheet. On the balance sheet, there's 3 parts. There are assets, liabilities, and owner's equity. The first element on your balance sheet are the assets. Assets are actually objects. An asset can be anything you can own, sell, and or claim. Assets belong to an entity and they're administered on the balance sheet. So they have a place somewhere. You put the value simply on that balance sheet and our financial picture. So you always have to know what value your assets have so that they can be traded with other entities. Now, my question is, can you name, for example, the assets of a supermarket? Simply pause your video and write some of the assets that you think are part of the supermarket. So maybe the building, or the card, or the products. Well, all the goods that you can buy in the supermarket actually belong to the asset. They're owned by the entity, by the supermarket. They can, of course, be sold. And, of course, it can also be claimed that this asset is part of the entity. Now, for instance, the carts or the baskets of the supermarket are also an entity, and it's an object that can be owned, sold, and claimed. So yeah, they belong to the supermarket. If they want, they can sell those baskets to other entities. Usually they don't want that because they need them themselves, but it sometimes makes sure that they break and that they buy new baskets for their customers to use. Yeah, for example, the counter in which the supermarket owner collects all the money is also an object which can be owned, sold, and claimed. Now, do you consider the employees to be an asset of the entity? Well, as you probably already think, owning people is considered slavery, and slavery is luckily legal since the 19th century in most European countries. So people are usually never an asset. Yeah. So on the other side of this same financial picture, we have liabilities. And liabilities are the elements what the entity owes somebody else or another entity. So as an asset, you could ask yourself, what does the entity have? Liabilities is the opposite. What does the entity owe? So there's a couple of liabilities that we have to list. For example, we have creditors. The creditors are simply just bills to be paid. It can be, for example, your dentist bill. Yeah, and if you don't pay this creditor, or if you just ignore that this creditor is there, then it will have some consequences, and this consequence usually is a reminder. So you get like a reminder bill or an extra reminder, and after that there can be a legal action to it. So it can be that there's somebody coming to your house and says, hey, you forgot to pay this and this. But other than that, there's not that much consequences. That's also because those bills to be paid for a consumer are usually not that high. So therefore, yeah, legal actions are already quite expensive to put in place in case somebody doesn't pay his dentist bill. Usually there's no interest to be paid on top of the bill when you don't pay your bills, or not much. It can be that you have to pay some kind of administration fee. For example, when you have a traffic bill, a traffic fine, then there's always a little extra that you have to pay that they put for administering your details. Other than that, it's reasonably yeah, innocent. Other liabilities include, for example, the long-term loan. Yeah, and difference between a loan and a creditor, such as a bill, is that usually the loan was planned. You know, so a loan has a certain prospect. So you were intended to actually, yeah, to acquire this money for a certain purchase that you were going to do or that you have done. So an example of a long-term loan can be, for example, a mortgage of a real estate, a house or a building. Also, there's consequences to that, but they're already a little bit worse because usually the long-term loan are a bit higher than most of the bills or creditors that you might have. Also, for a long-term loan applies an interest rate. So in the time that you haven't fully paid back this loan, you have to pay a certain amount of interest. For example, in this case, to the bank. Then we want to make a distinguish with short-term loans. That is also a planned loan, but has a length of typically less than a year. So it could be the equivalent actually of the current and non-current assets. Short-term loans are also usually intended. So can be done, for example, with a credit card. Usually also the consequences of not paying your credit card bills is reminders, because they're usually much lower than the long-term loans. The difference with long-term loans is that short-term loans can be having a relatively high interest, such as in the case of the credit card. That's why it is always wise from an investment decisions point of view to pay your bills directly with your debit card, with the money that you actually have, instead of with a credit card, which goes from an account with money that you actually do not have. So you can pay and buy assets with your credit card, even though you actually don't have enough money on your bank account. The final type of liability I want to discuss with you is debts. Debts are actually unplanned loans, not foreseen. They result in a negative amount on your bank account, for example, but it can also actually turn into a short-term or a long-term loan. So, for example, you have to pay back somebody that really needs to have it now, and you don't have the money. So what you're going to do is you, for example, arrange a short-term loan somewhere else to pay back this debt. Also, the interests of debts are typically relatively high. So what you can do, for example, for yourself is, hey, do you have at the moment liabilities? Are there any long-term or short-term loans that you have, or are there any debts? And are you actually paying interest for that? And finally, there's the owner's equity, or also called the private equity, or simply equity. Actually, the owner's equity is the owner's claimed value on the entity. Yeah, I'm going to explain later what that exactly means. First, we're going to check who is actually the owner. Who owns the entity or who owns the business. So in case of businesses, it's relatively simple. So it can be a shoe shop, for instance, that is privately owned. So I'm the owner, I got my shoe shop, and actually I work for it, and I have some employees, which are not my assets, but are actually people that I hired to do stuff for me. But I am the owner, and I have 100% share of this company, and therefore I also have a 100% share in the profit. So all the profit and all the loss that I make are actually mine. If the company or the business is not privately owned, it can also be owned by the shareholders. And shareholders are actually, for example, if you look at the Royal Shell and the oil company, they are not privately owned. So the people that work there, they don't own the company, but the company is owned by a number of people that own, so to speak, a note. And on the note it states you are so and so much percent owner of Royal Shell. So yeah, the company is actually owned by the sum of the shareholders, depending on the part that they share, which is stated on that note. They can buy and they can sell shares, and then they become a bigger or a smaller owner of the company. And if you look at the share in the profit of the company, that's also owned by the shareholders. So the more shares I have, the bigger owner I have, and therefore the bigger part of the profit will go to me every year. Then there are investors. They can also be a part of the company, but usually they put in an amount of money, and they don't wish to be the owner of the company itself, but if the company makes profit, they want a certain return. They want to have some money. It can also be that the investors have a certain agreement that they will get money, or they will receive a part of the money if the company is sold to another owner. Examples of those are startups in Silicon Valley, or other startups such as in the Netherlands as well. Also, companies can be not owned at all. For example, or entities, I should say. Typically, governments are not owned by anyone, like the municipality of Breda, for instance. So there's no owner, but actually it acquires money via the difference between the amount of tax and the amount of payments that they make. And that's basically the profit that they have. Although they don't call it profit, they just call it an increase of the equity. So now I hope you have a little bit better idea what the equity of an entity is. For this course, we will not specify the owner's equity, but we will assume that this is the value of this entity. Yeah. So either way, this is the money that determines more or less how much money can be invested for future purposes. So now we inquired the three ingredients of our financial photograph of our economic entity, namely the assets, the liabilities, and the equity. Now, this picture will actually look as follows. The picture has a debit side for all the activa, the things that we have, and it has a credit side for the passiva, or actually the things that we do not have or have to pay back. Also, our picture, just like any picture you take, has a moment that the picture was taken. And this is a very important part of it. So you have to add the date on which this picture was taken. In this case, it's the balance sheet for January the 1st, 2018 in euros, for example, for my shoe shop, or for a bank, or for a certain government. Then, on the debit side, we put all the fixed assets on top. The fixed assets are the assets that serve the entity for more than 1 year. Next, you put in all the assets that are current, or that serve the entity for typically less than 1 year, such as the hamburger the other day. But for a shoe shop, it could be also a shoe, or well, a light bulb, or anything that happens to break within the year. Then finally, you put down your intangible assets, or all the assets that you cannot touch. And it could be brands that you own, intellectual property, just like patents, but it could even be some sort of goodwill. Then you sum that up, because that is the total of all the things that the entity owns. So the building goes to fixed assets. And all the other typical things that can be owned are all in this list. So basically, if you add this up, you will have the total of everything the entity has. Yeah. Then actually what we have to do, on the contrary to what most scientists would do, is they would actually now list all the credits together. No, what we're first going to do is we're going to put this total X also to the other side. And that is because the balance sheet is a balance sheet, and therefore it's in balance. So we have to make that sure by copying the total of the debit side simply to the other side. So we make sure that whatever will be in this empty space, it will also end up in the same total. Then we will have the liabilities. Just like discussed, those are the creditors, the debts, the long-term and the short-term loans. There could even be a so-called collateral security. In Dutch, that's onderpand. But we will leave that for now, since you will probably not deal with that in the course and after. So if you add that all up, then that might be more or less than the total that we have just specified, which we copied from the other side. And the difference between the two is the equity. Yeah, so that means that it will always be that I have to add up the liabilities and the equity together to get to the same sum as I already calculated on the debit side. So the formula goes: all assets together minus all liabilities will give you the equity. The equity is always assessed by, for example, investors to check how much how healthy the company is. And the same goes, of course, for government. What can be derived from this healthiness? So if you have a lot of equity, people will say, okay, this entity is able to invest, for example, in new sustainable um, investments. What also is important is that when you know what the date of this photograph is, then it can be compared to a picture from another day. And so, for example, the same financial picture last year, I compare it with the financial picture of this year, may give me a signal whether the entity is actually growing or shrinking. Um, the balance sheet always contains all the financial elements belonging to that certain entity on that day. And actually, in reality, it's much more complicated than this. Um, the true value of an entity is, of course, also dependent by the determined by the market, and not only by what it owns and not owns. Okay, I'm going to summarize the last sheet in just one picture. Um, in recipe style, I'm going to say first, to make a balance sheet is administer the date for this balance sheet and put it on top of it. Then, second, you list all the elements that are considered assets on the left side. Then, number three, you sum up the total. Number four, you copy the total to the other side. Number five, you list the liabilities and put them on the right side of your balance sheet. Then you sum up the liabilities and subtract it from the total. And then the result is considered the entity. And whether you put the liabilities first or the equities first does not matter. Now, if you make a balance sheet for the beginning of a period and of the end of the period, then the change in the equity between picture 1 and picture 2 is actually the profit or the loss of your entity. Now we're going to make some fun. I put a balance sheet of a household. Yeah, first of all, I have to, of course, consider when this financial picture was made. Well, this picture was made on the 1st of February 2018. I put a debit side and a credit side. And on the debit side, of course, I always start with my fixed assets, the assets that are there in my household for typically longer than a year. I have a house for 2,000 euros, 200,000 euros. I have a furniture, my tables and my chairs and my bed and all those kind of things. It also includes my kitchen and my bathroom, altogether 11,000 euros. Maybe that doesn't sound that much for all my furniture, but you have to consider that this value is typically what I would get for it if I would sell it now to the market, and not the price for which I bought it, which sometimes is different and sometimes is the same. We will get back to that. Then I have a car which is currently worth 2,000 euros, and I play a cello, and that cello is worth currently 4,000 euros. Next to the fixed assets, we have the current assets. So those are the assets that vary within the year. They can grow bigger or smaller within the year. So for example, food and clothes are typical values of current assets. The food I will eat and drink today or tomorrow. And well, I will buy new clothes maybe within the year. And there's a couple of clothes that I will also give away or sell or throw away, obviously. But my bank account on which I have some money is actually a current asset as well. And that is because the money on that bank account is varying over the year. So that's why my bank account is always a current asset. It's the most important current asset usually. Finally, there should be some intangible assets, things that I don't that I cannot touch. Well, in my household, there's none. So if I would add everything up, then the total of the things that I have, all my assets together, are 231,000 euros and 150 euros. Well, Then the second thing I'm going to do is I'm going to copy this total to the other side. So I make sure that the total of the credit side is also 231,000 euros and 150 euro. And this sounds a bit strange because I still don't know what's going to be on top there, but I have to make sure that my balance is in balance. So I'm going to do that first. Now I have my long-term and short-term loans and my debts together. So I happen to have some short-term loans. There's a loan. I borrowed some money from Uncle Case, and I have a credit card on which I already spent 540 euros. And that was on a couple of whiskey bottles. So that's why also the food on the other side is a bit high. You see 2,000 euros. 500 euros of that actually was actually whiskey, which I own, so I have to put them on under food. But I also bought them with my credit card, not with money from my bank account. So I have to still pay that back to the credit company, to the credit card company. So both those short-term loans and the long-term loan are intended, because the long-term loan that I have is a mortgage. So typically long-term loans are coupled to one of the assets that I have. Well, in this case, the asset that is coupled to this mortgage is obviously my house. So what can be seen from here is that I made a long-term loan at the bank for 170,000 euros, and I bought a house for that. But currently this house actually increased in value. So it's not worth 170,000 euros anymore, but it actually expanded in value. That's because the market was actually, the market for houses is positive. So the demand is higher than the offering. Now there's a debt that I also have, and I actually listed over there. The debt is an amount of money that I was not intended to do. That was unfortunate, but I have to pay it back, and therefore it's over there. And now I can do the total of 231,000 euros and 150 euro. I minus that with the total amount of liabilities, and I will get my equity. The equity gives me an indication of how much my entity is worth. What's the value of it? If it becomes negative, then there's a risk of bankruptcy of my household. Now you can pause this video and you can make a balance sheet of your own private situation. So now some recap. In order to see whether you understood the slides previously, you can do this little exercise. Imagine we have a financial entity, which is a wood chip company. You see it on the picture. And this wood chip company actually brings in wood from the forest, and it crushes it to wood chips, and then it sells it as a fuel for heating of households by means of a fireplace or a stove. This company also produces electricity and heat out of the wood chips, and well, basically it has a couple of assets. Now please name the examples that belong to all the fixed assets, the current assets, the intangible assets, liabilities that the company might have, and give these examples a fictive value. So you just give them a value from what you think is logical. Then you make a balance sheet for this company for today, and you calculate the equity. Tell me then if the equity is positive, and it may also be negative. What if it's negative? What does that mean? Okay, good luck, and bring your example to the workshop lecture. The final slide of today is about added value. I already said something during the balance sheet slide about my house that has increased in value. That's one way of value increase. Now I'm going to give you a typical example on how value is made on the market. And I do that by means of the value added pyramid that you can see here. This example is about how value is created by a certain set of entities that interact with each other. And this example starts with a farmer. A farmer grows crops, and actually he has to buy some seeds somewhere, and he puts the seeds in the ground, and he puts some effort and some labor in it. Some machinery does some work for him, and at the end of the season he has some crops, for example wheat, and the wheat he can potentially sell. So as you can see, he has grown some crops out of nothing, and those crops are being sold, for example, to the miller. Yeah, so this value goes from one entity to another entity. The wheat is actually used by the miller. What does the miller with it? Well, of course, he breaks it down into smaller pieces, and he creates different products out of the wheat. So he does something to it. We call that the added value that he adds to the product by means of labor, machinery, and other costs that he makes. And he adds extra value to it, and he sells the whole product. So the value from the wheat, but also the value that it added to it, to the baker, and he calls it flour. Well, here you see that the flour has the value of the wheat, including the value added for the miller, and the baker also does something to his product. He uses the flour in products such as bread. So he has to add extra ingredients to it, some labor and some machinery that help him. So he also has to add some value to it. And the total product that the baker makes, he's going to sell it to the grocer. And the grocer actually sells this product as wholesale bread. And he also adds some value to it. So it's up to you to think about what this value would be. And then, after all, he will sell the wholesale bread, including the value added, to the retailer, to the consumer. And the consumer, just like you and me, we go to the grocer and we buy this retail value of bread, which is the final expenditure. Again, maybe you can also think of an example of this. So you can also think about a shoe shop, or you could maybe think of a sort of food which goes from here to there and gets a little bit of value added and is being sold to another entity, and so on. And in this way, you can basically feel how value added product works in the economy.